I would not be surprised to see 100,000 in the next 12 months. No firm view. And I think right now I wouldn't be surprised at chopping around 10K in either direction. Historically, the thing I see that correlates with Bitcoin the most is global liquidity, which is there's many ways to monitor that. I look at global broad money supply denominated in dollars. So there's both a dollar index component and a global credit creation component to that. In the past 2 years, that's pretty stagnant as all the central banks are trying to fight back on the inflation. It's starting to slowly break out to the upside. And so when we look forward 18 months, I would expect that to be higher. And I would expect Bitcoin to probably be higher with it.
Lyn Alden begins by emphasizing the correlation between Bitcoin and global liquidity. She notes that while Bitcoin has been relatively stagnant over the past few years due to central banks' efforts to combat inflation, there are signs of a potential breakout. Alden tracks global broad money supply, denominated in dollars, as a key indicator of liquidity. This metric combines the influence of the US dollar index and global credit creation. Alden expects global liquidity to increase over the next 18 months. This rise could be due to central banks loosening monetary policy in response to economic pressures or geopolitical tensions. As global liquidity increases, Bitcoin could see a corresponding rise in value. Alden suggests that this could be a crucial factor driving Bitcoin's price higher in the near term. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
I would not be surprised to see 100,000 in the next 12 months. No firm view. And I think right now I wouldn't be surprised at chopping around 10K in either direction. Historically, the thing I see that correlates with Bitcoin the most is global liquidity, which is there's many ways to monitor that. I look at global broad money supply denominated in dollars. So there's both a dollar index component and a global credit creation component to that. In the past 2 years, that's pretty stagnant as all the central banks are trying to fight back on the inflation. It's starting to slowly break out to the upside. And so when we look forward 18 months, I would expect that to be higher. And I would expect Bitcoin to probably be higher with it. So I look at those details. I look at some of the supply distribution details, in addition to these kind of political narratives and things that can pop up. I think right now, because it's in the narrative phase, it's mostly in the de-risking phase, which is to say that when you look at reasons why large pools of capital might or might not invest in Bitcoin, one of them has always been government regulation, government intervention. If it gets too big, what if they don't like it? Whereas the introduction of the ETFs, BlackRock publicly talking about it, prime dealers of treasuries saying they hold it and talking about it, and now presidential candidates from Trump to Kennedy talking about wanting a strategic reserve, Senator Lummis talking about a reserve. That is kind of, I would view as political cover, which is to say that instead of getting so big that the U.S. government doesn't like it, it's more like it gets so big that it starts to influence the government because the government's not a monolith, at least here in the United States and many countries, which is to say that some politicians realize that being on the side of that industry is good for them or good for their constituents. I actually think the news that went under the radar there was that they also had Democrat, politicians there as well, sitting congressmen. And during the conference, a number of Democratic congresspeople wrote to the DNC and said the party's got to change its course on this industry. And so even though the big headline speakers are more on the right of the political spectrum, there's actually this kind of bipartisan view that not being on the right side of this industry is kind of a losing battle in terms of votes, in terms of capital raising, and in terms of narratives for the country. So part of it is that as that runs higher and higher, eventually you get a problem with not enough buyers, and you could have a situation where the Fed has to go back and be a buyer, even if inflation's above target, which could happen as early as next year potentially, and you can get into kind of forced monetization. which, that if you're in a structurally deflationary environment and you have enough offsets of keeping prices low, that can be palatable. That's kind of what Japan's gone through, and they have a structural current account surplus and all that. But if you enter that environment in a great power competition or from a position of running a structural current account deficit, that could translate into more inflation that the average person sees, the average voter sees, the average investor has to deal with. And so that's kind of the main thing. In addition, the other factor is that it means that interest rates don't have the same effect they had in a lower debt environment. So, for example, when Paul Volcker was trying to deal with inflation, the majority of the money growth was coming from bank lending, and federal debt was 30% debt to GDP. So when he raises interest rates, he slows down the rate of bank lending, and he does blow out the fiscal deficit, but by a smaller amount than he slows down bank lending. Right, so it's on average his interest rate hikes are very cooling on the economy. Whereas if you get to 130 debt to GDP on the public ledger, and your deficits are bigger than your net bank loan creation in a given year, then by raising rates, it's more of a mixed bag because you're ironically increasing the deficit, which is somewhat stimulative for the private sector, at a faster rate than you're slowing bank lending. And it's not quite an apples to apples comparison because bank lending it's more cyclical, and the interest expense more goes to the upper echelon of income. So it doesn't have the same velocity as other types of deficit spending, but it does have a non-zero propensity to spend. And so some of those just inflation fighting dynamics become harder when you're that indebted. Private sector debt, especially when it starts to roll over, is disinflationary. That's what we saw after the global financial crisis, as we saw Japan go through. However, when you kind of rotate that debt from the private sector onto the public sector, and then you get to a point where interest rate hikes increase the deficit at a bigger rate than they slow down bank lending, that's when you do risk losing control of inflation. And it depends at that point how many offsets you have. If you're a country running, if you're super productive, if you're running a current account surplus, if you're not short on energy, it might not be that inflationary. But if you go into that environment and you're running a current account deficit and there's risks of energy shortages or risks of supply chain disruptions, and you're running 6, 7, 8% of GDP deficits structurally, and the central bank has to buy some of it, regardless of what inflation's doing. Right. So, for example, the Bank of Japan was buying bonds while they had above target inflation because they didn't really have a choice. And so when you get into that kind of loop, that can give you a higher background level of inflation than you get in other macro context.
Alden points out that the structural issues in the U.S. Treasury market, such as the lack of sufficient buyers for the massive amounts of debt being issued, could also contribute to a more favorable environment for Bitcoin. As the government and central banks intervene in the market, either through regulation changes or direct purchases, the resulting monetary expansion could drive more capital into Bitcoin. Alden also touches on the global aspect of this economic shift. She explains that while US banks and institutions have historically been major buyers of treasuries, recent years have seen a slowdown in foreign purchases of US debt. This is partly due to the limited amount of dollars circulating globally and the increasing debt issuance by the US government. As a result, there is a growing imbalance between the supply of treasuries and the demand for them.
Part of it is the sheer amount of it hitting the market. Right. So, and for example, U.S. banks have historically been a big buyer, but then some of them literally went bankrupt because of it. Right. The volatility of it. They have to have certain liquidity characteristics. They have to have things like enough cash and T-bills and things like that as a percentage of their assets. And some of those long duration treasuries are a risk they have to balance around. So eventually you can kind of stuff overweight treasuries in so many different places that there's just not a lot of buyers for them. In addition, the rest of the world buys our treasuries, but they've not been buying at a very rapid pace in recent years. And they can only buy with dollars that they have. So, if our they run trade surpluses with us on average, the rest of the world. And they take that and buy our assets with it, including some of our treasuries. But if our treasury issuance is just massive compared to how much dollars we're putting out into the rest of the world, there's only so much foreign dollars that there's available to flow back into our treasury. So you start to get major imbalances. And that's where you kind of get, in 2019, it was the repo rate that broke, and they had to go back to increasing their balance sheet. There are little like plumbing issues that break when you get really big imbalances of how much debt is stuffed into the market. And so they either have to do regulation changes to, for example, let banks hold more treasuries, or, which is kind of like shadow QE, or the central bank can come in and buy it, or they can regulate pensions to have to own more treasuries, but then you potentially impact their returns. So there's kind of trade-offs that they start running into when the amount of treasuries is very large compared to, say, the monetary base, or compared to bank balance sheets, or compared to foreign appetite for dollars and treasuries. Yeah, it's a mix of both. So out of the 35 trillion, so some of it's owned by the government itself, right? So some of it's owned by Social Security. So you take several trillion off of that, and you have the net debt. Then off the top of my head, something like 8 trillion of it is owned by the foreign sector, which includes both central banks and private pools of capital, foreign, and then the rest of it's held domestically. Some of those trillions are held by banks, so it's going back into bank profits and coming out in bank dividends and going to bank buybacks and all that, or going into just their overall capital base. Some of it's owned by pensions, some of it's owned by mutual funds. Some of it's owned by a lot of individuals. Anyone who has money market accounts is funding some of those T-bills, for example. People that own ETFs, in their Vanguard account, or in their brokerage. That's kind of how it's dispersed. And it is true that the majority of that interest does flow back into U.S. holders of it, but that's ironically somewhat stimulatory and inflationary, which is why I go back to my prior point. Rate hikes become slightly less effective at dealing with inflation when you have debts and deficits that big, because that's ironically stimulatory. Like, if I have a locked-in mortgage, so it's super low, it's not going anywhere, and I have money markets, every time the Fed raises rates, they give me a raise. I can go spend more now. So if their whole goal is to slightly cool down the economy, it's a mixed bag, because they're cooling down some people, but they're not cooling down me. If anything, they're saying they're giving me more money, right? And suggesting I go spend it, which is not. It's kind of counterproductive to what they want to do. The same thing for big corporations. Every time they raise rates, they give Google a raise because they got a big cash pile. A lot of it's in short duration securities. And so they get a raise, whereas they hurt some of the more leveraged companies. They hurt the real estate. They hurt the small businesses. And so you're right that there are stimulatory effects. They can translate into inflationary effects depending on what the inflationary offsets are. And it makes it just more complicated to manage, the Fed's mandates when there's such a public interest expense element to their interest rate hikes.
Alden concludes by discussing the potential long-term implications of these trends. If central banks are forced to continuously intervene in the markets to maintain stability, it could lead to a scenario where inflation becomes a persistent issue. In such an environment, assets that are perceived as scarce and decentralized, like Bitcoin, could become increasingly valuable. Please like and subscribe my channel.